This chapter is the largest chapter in economic survey, but also the most fruitful one because you get at least three MCQs from this chapter every year. Here, I've highlighted certain terms: GNPA, CRAR, Financial Inclusion Index of Reserve Bank of India, Development Financial Institutions. All of this become potential questions in this year. So, welcome to the second chapter of Economic Survey series, the second video, also the most important one. Let's take up all the issues discussed in this chapter one by one, which are important for prelims. If you already know the basics behind all these topics and you just came here to note down certain important facts, these are the facts that you need to know. If you don't know what these facts mean and what is the actual meaning behind it, let's deep dive into each of them. Banking sector plays a very important role in providing credit for businesses. Without this credit, you are not able to see any kind of economic growth in our country. We will see how. So, in this context, there are certain important concepts like gross net non-performing assets. How do we address that issue? What do you mean by capital risk adequacy ratio? How does it improve the profitability and stability of banks? And finally, what is the fundamental problem of this entire banking sector? Let us examine. Now, before we proceed further, let's understand how a bank works. You are a depositor. You take your money. Let's say you take 100 rupees of your money and go deposit with a bank. Since you're putting this money here, bank takes this 100 rupees and gives this as a loan to someone else. And because they earn an interest, let's say 10% is the interest earned on this 100 rupees lent. Out of that 10%, that is 10 rupees that one gets out of this 100 rupees as interest, maybe the depositor will get 4 rupees. The rest 6 rupees is the profit earned by the bank. That's how banks operate. And if the interest earned on loans is much more higher than the interest paid on deposits, that's a profitable model. If that is not the case, banks will not make money. Economic survey use this term called CRAR or the capital risk adequacy ratio. Globally, this is also called capital adequacy ratio simply. Now let's understand what this is. Why do banks need capital in the first place? Now imagine you're walking on a tightrope. Wouldn't you want a safety net below? That's exactly what this capital is all about for the banks. It's their financial safety to absorb the losses if things go wrong. Now, when depositors give money, banks just don't sit on it, right? They give it to loans or lend it to big institutions to make some profits. What if the borrower don't pay back? As a cushion to that risk, we look at the capital. Loans not being repaid or economic crisis happen all the time. And without enough capital, banks would just collapse, and that's bad news for economy. Now, the first question that UPSC can ask in a very simple term is, what is the purpose of capital? Answer is shock absorber for losses. So it can twist this statement in the question and say, capital is for starting a business, etc. No, the main purpose is to act as a shock absorber against losses. Very simple, right? Now, let's see the types of capitals in a bank. Regulatory institutions divide the capital, and we are talking about something called tier 1 capital and tier 2 capital. Now, think of tier 1 capital as the strongest safety net and tier 2 as extra layers of cushion. Okay. Tier 1 is bank's own money, like funds from shareholders and profits saved over years. It's the most reliable because it's permanent. Please note this, it's something that is permanent. Okay. And this is readily available. So, this is bank's own money. That is what you need to remember about tier 1 capital. It is a core strength. Now, how can UPSC ask a question on this? See, UPSC loves to confuse us, right? So they might ask which capital is considered the most reliable for bank. They can say additional tier 1 or tier 2 capital just to confuse us. Remember, tier 1 because it's the bank's own skin in the game. It's their own money. Now, tier 2 capital is simply like a backup generator. When power is off, you need a generator, right? So tier 2 capital is like that. It includes things like subordinated debt. Now, let's say, for example, to understand this concept of subordinate debt, which is a part of the tier 2 capital, I want you to understand a fancy term called payment hierarchy, which is nothing but a way to say who gets paid first in terms of a crisis. Depositors or people like you and me, these are the safest people. If something happens to the bank, they are the first to get their money back. Why? Because there is something called Deposit Insurance Credit Guarantee Corporation. Banks are required by law to protect depositors first. In India, depositors' money is insured up to 5 lakh rupees. Okay, you might be having 15 lakh rupees in your account, but you'll only get 5 lakh rupees back if something goes wrong to the bank. That's a different thing. But at least you're getting something back. Now, there is something called senior debt. This is big institutions like mutual fund or companies, asset management companies that lend money to banks by buying certain bonds. This is called senior debt. What happens if the bank fails in this case? They are paid after depositors. This is the second priority. But before the subordinated debt, because their money is considered essential for banks' long-term functioning. Example, I'll give you one example. Let's say there is a pension fund. That pension fund gave 100 crore rupees to the bank by buying its senior bonds. If the bank collapses, depositors get paid first, and then this pension fund will get its money back. Second priority. So, of course, it is relatively safe, but it's not as guaranteed as depositors because at least have an insurance. Now, here comes the subordinate debt. Who are they? Big investors or hedge funds. They take this risk in exchange for a higher interest rate. Let's say, for example, if they're getting some X percentage senior debt, these guys, the subordinate debt lenders, will get X plus 2% additionally. I'm just giving an example. Why are they doing this? For higher interest. But what is the risk here? Why is it considered to be more riskier than any other kind of debt? Because they only get paid after depositors and senior debt holders. And sometimes, if the money goes away, they don't recover anything at all. Now, you might be wondering, why will someone invest in such kind of a bond when everything can go away? Just like they say, investors who take risks will get more returns. Risk hai to ishq hai. Now, UPSC might ask, why do banks prefer this subordinated debt when they can raise equity? Because it is cheaper than raising equity. Let's say, for example, if the bank grows 100x, they will have to pay the investors 100x rather than the 10% interest that they will be giving on subordinated debt. So the banks will take risk. Investors will also take risk. Now you might be getting a question. I said that capital is bank's own money, but then how on earth am I calling something that is taken as debt a part of the capital? Why would regulators call subordinated debt, which is a type of a loan, capital? Isn't capital supposed to be bank's own money? Now let's try to understand this. What is the purpose of subordinated debt? It is basically meant to absorb the losses, right? If the bank fails, this debt can be completely written off. What is this written off? Let's get back to that. It can be completely written off, or let's say the bank says, hey, just because you gave me money and because you trusted us, I don't want to let you down. I will convert it to equity. I will give you a share in the future if things go better. So that means it acts like a cushion to protect depositors and reduce the need for taxpayers' money to save the banks. Let's say a very big bank like SBI goes for a toss. The government should come into the picture, otherwise, the economy will collapse. To avoid that kind of scenarios, you will have this loss absorbing subordinated debt. Now, let me give you an example. Let's say there is a bank X, it has 100 crore assets, and within this, you have 50 crores worth depositor money. And the bank borrowed senior debt, let's say, for example, from mutual funds, 30 crores. And finally, there is 20 crores worth of subordinated debt. And if something goes wrong, let's say 40 crores went away in bad loans, sir, the people who took the money from the bank, they're not able to repay the loans. Now, what will happen? Obviously, this 50 crores is Aam Aadmi ka money, common man's money. They have to give it back. There is also some insurance component. So these people will get the money first, no matter what happens. Then, in the second order of priority, the senior debt holders will get that money back. But this 20% or the 20 crore rupees, which is there in subordinate debt, they absorb the loss. Bank can take a decision that, hey, I know there is a 40 crore loss, but I'm using your 20 crores to completely say that this is a loss and you are not going to get any money back. And my present liability will only be 20 crores. My present loss will only be 20 crores. This is the purpose of subordinate debt. And since that risk is there, these people get a higher interest than other people. But isn't this a liability? Please don't forget this is always a liability, but not immediately. This crisis is immediate. Let's say you have to come out of this crisis in the next 1 year. So this liability is a long-term debt. Like that's the reason subordinate debt is always long-term. Let's say, for example, 10 years. But the crisis is very immediate, right? Let's say for like 1 year, you can recover from that if there is 9 years of time to pay back this money. So that's the reason it is called both a liability in the long term and a capital in the short term. And that's the reason why regulators allow this subordinate debt to be treated like a capital. You understood what tier 1 and tier 2 capital is, the importance of subordinate debt, why is it both a liability as well as a capital. Now you have to understand this important concept called additional tier 1 bonds. This additional tier 1 bonds are a special kind of a subordinated debt, but much more risky. Let's say normally depositors get 4% interest and subordinated debt, let's say tier 2 investors will get around 10% interest. This additional tier 1 bond holders will get even more percentage, let's say 12 to 15%. I'm just giving an example, not exact figures. Please don't, go back and ask me if these numbers are right. Just giving an example. This 81 bond holders will get much higher interest, 12 to 15%. Since they are taking more risk, there is some caveat here, right? And if it is a subordinated debt, why not include it in tier 2? Why include it in tier 1? You might be getting this doubt. So let me help you explain that issue with a crisis which happened in 2020, the Yes Bank crisis. So when the Yes Bank collapsed in 2020, people who invested in this additional tier 1 bonds, almost 8,400 crores, entire money was wiped out. Investors lost all that money. The risk is that high. So what is this additional tier 1 bond? Let me help you explain that. So this is a special kind of a subordinated debt, but they never mature. Meaning, I told you, right? Subordinated debt, let's say they have a longer tenure, like 10 years. You have to pay that entire money back. But in this case, you are never going to get that money back. Let's say you invest 100 rupees. Every year, forever, you're going to get 15 rupees as interest, 15% return. As long as the bank exists, you'll get that money. Something nice, right? Of course, yes, it is nice, but there is also a caveat here. If the bank does well, great, nothing like it. But if the bank goes for a toss, as it happened in Yes Bank, you're going to lose the entire money. The reason why it is included in tier 1 is because it absorbs losses immediately like equity. You are not going to get any money back. It is very risky. You are not even going to have ownership. But like I told you, subordinated at tier 2, more interest is generated than that in additional tier 1 bonds. And that's the reason why investors take that risk. So that is the whole concept of capital in a bank. It is very important. I'm expecting a question this time. A quick recap. Tier 1 capital is the core strength of the bank. It's their own money. Tier 2 capital is like a backup generator. They have debt, reserves, etc. And here is one important additional concept called capital buffers. We'll look at that. It is like an extra sheet. Beyond what you already studied, over and above that, you have certain buffers. Remember, this capital is not same as deposits. UPSC can use this to confuse us. Capital is different, deposit is different. That's the reason you have to focus on this. Deposits belong to customers and capital belongs to banks. This buffers that we are going to talk about, they don't replace capital. Let's say if capital is X, over and above that X, let's say 0.25% or 0.5% or 10%, whatever may be the number, as set by the regulatory bodies, that is called an additional buffer. What are they? Let us have a look. If you're building a skyscraper, you need to make sure that your foundation is very strong. And the taller the skyscraper is, the stronger the base should be. Banks are also like these skyscrapers. They lend money, take deposits, invest in risky assets, but if they don't have enough financial strength, that is, if their base is not strong, they can collapse. This is what exactly happened in 2008 financial crisis. To avoid that kind of scenarios, globally, different countries came together and formed something called the Basel Committee on Banking Supervision. This committee decided on certain capital requirements for the bank across the globe. If the economy is supposed to be strong, these rules should be adhered to very strongly. Otherwise, when the economy is growing, banks will recklessly give loans and they will not be able to recover that when the situations turn bad. To understand this whole concept of Basel norms, let's get back to a concept called risk weighted assets. Now, when a bank gives money, not all loans are equally risky, right? Let's say if a bank gives a loan to a government project, it is considered safer than a loan to, let's say, a corporate entity or a startup. It can be a very big proven company or a normal startup. All of them will get loans. But bank will not assess the risk in the same way. You know for sure the government will pay back. You know that there is a 50% probability that a big corporate company, when it takes a loan, it will pay back. But when you're giving it to a startup, it's like taking a bet. If the startup clicks, you're going to get 100% of the return, or you're going to get higher return. But if it fails, there is a sure shot guarantee that all that money will be lost. So this risk weighted asset because loans generate some income, interest income for the banks. That's why they're assets. So in simple terms, RWA just means the total assets which are adjusted for risk. Now that we understand the concept of risk-weighted assets, let's talk about the capital requirements of the bank as per Basel III norms. See, totally, as per Basel III norms, if 1,000 crores is the amount of money for risk-weighted assets, in that 11.5% should be the capital that is meant for shock absorbing, should be kept aside. How will you source this capital? That also is decided by the Basel Committee. 5.5% should be in the term of equity. Additional tier 1 bonds should be 3%, tier 2 bonds should be 2%, and there is a concept called counter cyclical capital buffer. I will explain this. Over and above this, let's say, for example, as seen here, if the central banks want to, impose additional capital to activate this counter cyclical capital buffer, they can do that also, but it's not mandatory. I just gave you an example here, total capital requirement. If you combine all of this, you can see here, right? Now I'll tell you the example of how this counter-cyclical capital buffer can be used. Let's take the historical example of 2008 crisis. What happened back then? Central banks did not say that, you have to maintain this mandatorily. They gave risky loans to people who can't even afford them. Let's say a lot of banks in US, because there was so much money flowing into the economy, they just wanted to give loans to make more and more money. Even a normal person who could not afford to pay the EMI of a single home, they got three or four homes, three or four house loans. And when the money was asked, they just said that we don't have the money. If you want to take the home, take the home. So, what practically happened in 2008 was banks were sitting with an inventory of unsold or unused homes. The construction industry was benefiting from it, but the banks had nothing to do with that homes. They didn't know what to do with it. And because of this reason, because there was no strict capital requirement for bad times, the entire economy collapsed and the government had to bail in. Taxpayers' money was used to pump in and save these banks, otherwise, the economy will collapse. We didn't want that kind of a scenario again. And that's when Basel Committee came into action. Did it save us? Let's take a look. In 2020, when the COVID crisis hit the world, global economies came to a standstill. Businesses collapsed, and entire economy was shut down overnight, just with lockdowns. But banks still had to follow this Basel III norms, and they use this extra capital buffer to save themselves from a crisis. What is the outcome? The banking system remained stable, unlike in 2008, where it recklessly lent. That did not happen across the world in 2020. So this shows the importance of this counter-cyclical capital buffer. Now you might be wondering, why is it called counter-cyclical? Because why would you save money when the times are good? Just common sense, right? If you have extra money, you have to save it for the bad times. That's what we are doing here. Now you might be wondering, this is an economic survey class. Why are we reading all this? Like I told you, if you are just someone who is good with concepts, just facts are enough. But if you want to understand, this chart is very important. What does this chart say? CRAR, the capital risk adequacy ratio norms, which was set up by the Basel Committee and enforced by RBI in our country. Those are well above the required norms for scheduled commercial banks. And it is coming from tier one capital, meaning banks are making enough profits to reinvest it into tier one. It is a very good sign. If CRAR norms are above the normal, it means that the banks are extremely strong. This is the takeaway. I want you guys to appreciate this graph. It has been increasing steadily. Now let's talk about the non-performing assets. Why there is a decline in the gross non-performing assets? What is it all about? What is this chart saying? Let us understand that. Now let us understand the concept of a non-performing asset. If a borrower stops repaying the loan for more than 90 plus days, that loan is considered to be a non-performing asset as per RBI. Now, before this, you also have something called the special mention account. There are three categories: SMA 0, SMA 1, SMA 2, and NPA. Now, SMA 0 is a type of account where if the overdue is between 1 to 30 days, it's an early warning stage. Borrower will display the first sign of stress. If the borrower does not pay the lent amount for 31 to 60 days, it is considered to be SMA 1, and SMA 2 or the special mention account 2 is 61 to 90 days. Over and above that, it is considered to be a non-performing asset. Now, RBI has set certain rules to deal with this NPA. Let's look at them with an example. Let's say, for example, bank gave 100 crore worth amount in loans. In that, if 10 crore worth loans turn NPS, that is, the loans are not paid after 90 plus days also, they will be considered gross non-performing assets, GNPA. Now we have to understand a concept called provisioning. Now, economic survey says that NNPA is reducing. What does this mean? The gross NPA minus what we are talking about, something called provisioning, certain amount set aside. Now you might be wondering, why are we even again talking about setting some amount aside? Didn't we do exactly the same when we were talking about the capital? If some bad loan happens, aren't we supposed to look at the capital amount and ensure that the bank is running safely? Let me help you clear that entire confusion through a practical example. How exactly is this provisioning different from capital requirement? Let me explain. Let's say, step one, you have a bank X. The owner of that bank has 100 crores in his pocket, so he started a bank. Now, as per RBI's requirement and Basel norms, you need to have 11.5% as a capital that is set aside for shock absorbing. The bank will start accepting deposits, etc. But the maximum amount that the bank can lend will be 100 divided by 11.5%, which is the CRAR percent, that is 869.5 crores only. It cannot lend, let's say if it gets 1000 crores in deposit, all the 1000 crores cannot be used for lending. Now, step two, out of the loans given in the first year, let's say 100 crore worth NPAs were found by the bank. So if RBI says that, hey, according to this risk weight, I found that there is a 50% chance of this NPA permanently going as a loss. So set aside 50 crore from your annual profits. So let's say if profits are, let's say, 200 crores, reduce 50 crores from that, your profit will be 150 crores only. Here, if you notice, there is no discussion of capital at all. Provisioning will only impact the profits. It's just an accounting entry. Now, move to the second year. We notice that another 200 crores NPA was found, and same RBI says that 50% should be kept aside from the profits. Therefore, 100 crores should be set aside from the profits. But the bank had a very bad year that year, and profit is only 75 crores. So, actually, for the provisioning, you are 25 crores short. This 25 crores should be taken from the capital, that is set aside. Now, we began with 100 crore capital. Now you only have 75 crore. Now, the maximum amount that a bank can lend is only 652.2 crores as per this calculation. This is a permanent reduction. That is why provisioning is different from capital requirement. Please understand, provisioning will impact profits. It is to slow down. It's like a speed breaker. Okay. So don't confuse the provisioning concept with the capital requirement concept. This is a temporary thing. Provisioning is for ensuring that profits are handled better, and capital requirement will permanently make the bank weak. So if NPAs continuously increase, banks are supposed to recapitalize their bank sheets or the balance sheets. Otherwise, they will not be able to function strongly. That is the difference here. I hope you understood the difference between provisioning and capital requirement. Don't confuse, even though the end result or the end intent is to keep the banking system strong. Now, what does the economic survey say? Out of the total assets, just 0.6% are NNPAs. The net non-performing assets are just 0.6% of the total loans given. Out of this, restructured assets are 0.7%. What does it mean? Sometimes, if banks think, because of genuine conditions like, let's say, COVID, the businesses are not able to pay the money back, they will readjust the terms of repayment. Let's say if you're supposed to pay in 1 year, the bank will consider the genuine cases, and let's say they will increase the tenure for 3 years. That is called restructuring. But it doesn't mean that the person who took the loan will be able to pay the money back. So the restructured loan, if they fail, they will turn into NPA, and this will require higher provisioning. Please ensure that. So this is what the economic survey says. The health of the banks is very good. That is what the economic survey is saying, because the gross non-performing assets has been continuously coming down. Now let's consider this bit. Which of the following statements are correct? Now take a look at this. Provisioning affects a bank's lending power permanently, reducing its capital base. No, provisioning affects only profits, not capital. So this statement is wrong. You've already seen why. Increasing in capital requirements permanently lowers a bank's lending ability. In the previous example, initially the banking capital was 100 crores. After the 25 crore loss, it became 75 crores. Now, if I make CRAR from 11.5% to 15%, what will happen? 75 crore by 15%. I can now lend only 500 crore even if I have 1000 crores worth of deposit. What will the bank do with the rest 500 crore? It will just be keeping it aside for cushioning. Now, the bank's lending capacity drops further. Even if NPAs are reduced, banks cannot increase the lending unless it raises new capital. So, the bank should further dilute the ownership. Let's say, for example, if the bank wants to raise 50 crore capital from the market, along with the 75 crore capital it has, it will have to raise new equity, new bonds, etc. Now, the new lending capacity will be let's say 75 crores plus 50 crores, that is 125 crores, and then 15%, 833 crores. So the bank can lend only after it raises new capital, but it took 2 years almost to recover from that situation. That is why provisioning is different, capital requirements are different. Bank can lend more only if the capital requirements are met. So RBI will not tweak the capital requirements just like that because it will take a lot of time for the economy to recover if RBI keeps doing that. Provisioning is the way to handle the short term stresses. Provisioning impacts a bank's profit before impacting bank capital. Obviously, it's true. We have seen in the previous example. So, the first statement is wrong, and these two statements are right. Only two statements are correct in the above example. Now, let's understand the concept of net interest margin. What is this net interest margin and why is it declining? Let us understand. Let's say bank lends 100 crore rupees to its customers. Depositors gave this 100 crores. So bank borrows 100 crores at 5% interest from its depositors and lends it at 9%. So what is the net interest margin here? It is 4%. Imagine if RBI is increasing its repo rate, or because of competition, banks are forced to increase the percentage that they will be giving to the customers. Let's say 7% is what they will be giving to the customers. The net interest margin will come down to just 2%, right? What is the implication here? Lending becomes less profitable. Profits are coming down. That is what economic survey chart says. Now let me digress a bit because these points are important for prelims examination. What is repo rate, what is reverse repo rate, and how they impact the entire situation in the economy. Let's just take a brief look at it. What is repo rate? We know that RBI prints money, right? But it cannot print money indiscriminately. It should be backed by certain government securities, and it will mandate the banks to buy those government securities. So this repo rate or the repurchase rate is the interest rate at which RBI is asking the banks. Banks borrow money from RBI by selling the government securities that they are having in their repositories. Why do they do this? Because sometimes banks can have short-term, crunches, right? Higher repo rate means more expensive borrowing for banks and therefore higher rate of interest for the consumers also or the customers. Lower repo rate means cheaper borrowing. Now, what is reverse repo rate? Sometimes RBI borrows money from banks when there is too much liquidity in the system and inflation is out of control. So banks park their money in RBI because they're not able to give more loans. People are not taking loans or there is excessive cash. So RBI offers, let's say, something less than the repo rate. Usually there is a policy corridor. The repo rate, let's say if it is X, reverse repo rate is usually X minus some 0.25%, 0.5%, or whatever that RBI decides. What is the purpose here? Liquidity absorption to control money supply. Coming back to this charts, return on assets of SCBs or the scheduled commercial banks and return on equity of scheduled commercial banks. Net interest margin is not the only way in which banks make profit. Let's say, for example, there is investment banking. Here, companies raise money, right? So to give that investment advice, banks will charge certain fee. For that also, they earn certain income. Wealthy individuals have their wealth, and if you have to manage the funds for high net worth individuals, for that also banks earn a fee. Forex trading, derivatives, credit card fees, transaction fees. There are many other ways in which banks make money. And despite the net interest margin coming down, because other incomes are increasing, ROA and the profitability is still improving for the banks. That is what this economic survey says. So, if ROA is high, it just means that bank is running efficiently. And if ROA is low, bank is holding excess assets that is not generating enough income. Now let's take a look at this concept of return on equity. What does this mean? It simply means, let's say a bank A has 200 crores in equity and earns 50 crore profit. So what does this mean? Return on equity is 25%. That is 50 by 200 into 100%. That's 25%. This means for every 100 rupees of a shareholder's equity, bank is earning 25 rupees as profit. So ROE is all about the shareholder. How much profit is it giving to the owners? And ROA is all about how much bank is making as a profit from its assets. Now, what is the link between ROA and ROE? Let's say if ROA is less than ROE, it just means that bank has low leverage. That is, it is running with equity. There is no element of debt. It is not borrowing from the market. So it is, if it is the reverse case, if ROE is more than ROA, it just means that the bank is using debt to boost profits. Please understand this link. How? See, basically, bank needs certain amount of capital. It needs certain amount of money with it, right? Tier one, tier two capital. If tier two capital is more, it means that bank is running more with borrowed capital. So by owners taking more risk because they will have to pay this money back, they will be getting more returns. But in downturn, that is bad economic cycle, they will suffer a loss. So risk reward ratio, it's basically about risk reward ratio. So there can be a question by UPSC on this. What is the relation between ROA and ROE? This is a measure of profit. This is a measure of how much return the investor will get. If ROA is less than ROE, it means that debt is low. If it is more, profits are driven by debt. Just understand this correlation. Now let's consider this question. Consider the following statements. ROE is always higher than ROA in a highly leveraged bank. Like I told you, leverage means taking debt. We have already explained this. This statement is correct. ROA considers only shareholders' equity, while ROE considers total assets. I forgot to write this. ROE considers total assets. Is this statement correct? Obviously not. ROA definitely considers the total assets. Only, I've just reversed it. ROE considers only shareholders' equity because return on equity, as the name itself indicates, it's basically concerned about profit for the owner. Now take a look at this. If ROA is falling, return on assets is falling, and return on equities is increasing, it just means that the risk is not on the owner of the company or the equity owner. It is driven by debt. I've already explained it. Excessive leverage. So this statement is right. So 1 and 3 are right. Second statement is wrong. UPSC can ask a question like this. Basically, a bank should balance between ROA and ROE. They should go hand in hand. Otherwise, it is unfair if the owners are getting more profit and the return on assets is very poor. It just reflects poorly on the performance of the bank. The next concept that you need to know from economic survey is the credit growth cycle. You can see in this image. This image is showing how the trend in bank credit dispersal is happening and highlights that there is a new credit upcycle. What does this mean? Let us examine. During an economic boom, borrowing will increase drastically. But after that phase, regulatory bodies like RBI will intervene and try to slow down the lending because it will become risky otherwise. How do they do that? By increasing the repo rates, etc. So after the COVID, borrowing increased drastically. After that, RBI tried to intervene to control inflation, increase the repo rate. So there was a moderation. So the rate of increase in taking credit, again, taking credit is important for businesses. Never think that we should stop giving loans, but slow down the rate of increase. Let's say if the rate of increase is 10% in the previous year, we have to slow it down to make it 5% and focus only on low risk borrowers. RBI is doing exactly that. So credit to GDP ratio will be there. You have to try to minimize that in terms of minimizing the risk. So if this is shrinking, it just means that our growth is sustainable. Otherwise, it will become unsustainable because you cannot have GDP growth based on credit. Ultimately, credit means it is a loan. You have to pay it back. And if you lose that ability, economy will be at loss. So this credit to GDP ratio, if it keeps on increasing, it will keep the economy in a risk. So that is what this economic survey chart says. There is a trend that you can see here. There is a downward trend. Bank credit is increasing, but very steadily. Year on year growth is slowing down, but it doesn't mean we stopped altogether. The rate of increase is just moderating. One of the reason for that is SDFC, which is one of the largest banks. It was, we don't have to get into the details, but there are two entities which got merged, and this temporarily affected the loan portfolios for big corporates. Now take a look at this chart. Indian economy is witnessing the commencement of a new credit up cycle. Now what does this mean? We have already discussed what credit up cycle means. It should be sustainable. You can see here it is increasing sustainably. Two important points. What do you mean by credit up cycle here? Note that I'm not saying that in a credit up cycle, we are not at all giving loans to the banks. Banks are definitely improving their credit dispersal. Total bank dispersal is rising, but the rate of growth is slowing down because banks don't want to give loans to risky, customers. So there is an increasing credit demand, but only by ensuring that their NPAs and NPAs, that is the non-performing assets, are under check. These 2 points should be kept in mind. Credit up cycle or new credit up cycle means that it is not stopping loans. An economy cannot afford to stop loans. Also, if in UPSC there is a question which says that in the new credit up cycle, if the growth is supposed to be sustainable, if there is a statement that says it is sustainable only when the credit GDP gap is expanding, is this true or false? Like I've already explained, it is false. Why? Because if you are expanding credit, it becomes unsustainable. You have to not expand the credit to GDP gap in a phase where you have to tread carefully. Please note this point. The context is extremely important to maintain sustainability. You cannot expand credit to GDP ratio when you have to take care of the economy when it is risky. This is exactly what the economic survey says. The narrowing credit to GDP gap means India is growing without taking unnecessary risk. Okay. And we are also comparing our economy with other similarly placed economies. Look at this chart. China, Malaysia, Brazil. India is placed somewhere here. See, there is a this is a dual-edged sword. India's bank credit to the private sector is low. That is just 56.6% of GDP compared to other countries like China, which is aggressively lending to the private sector. This means that there is still room for financial inclusion and credit penetration relative to its GDP. So we have to move towards financial inclusion. This can be, used as one of the metric. There can be a question in prelims. You can also use the statistics, to prove your point in mains also. Cross-country comparison. India still has a relatively low credit to the private sector compared to other countries like Malaysia and China. You can use this point. So RBI comes up with something called Financial Inclusion Index. Please remember this. UPSC can ask this. Who comes up with this index? RBI. It is not SEBI. It is not any other body. It is RBI. Previously, I made a video on banking classification. I'm not repeating that lecture here because this is something that is covered in the basics. Economic survey mentioned NABFID, IFCL, regional rural banks, and therefore I made this question. You can pause this video here, take a look at this question, remember this topic. If you want any more details, you can post in the comment section below. I will try to address them. But also look at this lecture that I will be attaching in this video. You can see this I link at the top of the video, right? I'll be posting that banking classification video there. You can watch that. More such videos are coming. If you want any such specific video, and if you like this video, please do like, share, and subscribe. It will encourage us to produce more such quality content. That's it for now. See you soon.